Hi everyone, welcome to my YouTube channel. My name is Cherry Chen. I'm a chartered professional accountant located in Oakville, Ontario. Today, I have Elizabeth Kelly here, who is a very well-versed real estate investor, as well as a very renowned real estate coach, investment coach. The reason why I have her here is because my goal is to become the Google map for hardworking Canadians seeking financial freedom, and having the right coach to show you the path is the one easier way to shorten the path to success. So hi, Elizabeth Kelly, thank you so much for joining me today.
Thank you very much for having me. It's an honor.
Yeah, tell us a little bit about your investment and your portfolio.
Sure. My husband and I started investing in real estate in 2005.
Wow.
And so we've been doing it kind of the dinosaurs, I feel a little bit like in the community. But we've done pretty much every strategy as the opportunities have presented themselves over the years. We now live in Kirkland Lake, where we manage about 400 units. For the most part, they're apartment buildings for ourselves as well as for other investors. And I've been a coach. I was a trainer for Rich Dad Canada for 8 years, and I've been a one-on-one coach for about 4 years now.
Wow, that's amazing. 400 units.
Yeah, it keeps us busy.
Wow. And you self-manage them?
Yes, we have a company. So they're not all our units. Some we manage on behalf of investors, but we have a full-service property management company. So we deal with everything from filling vacancies, minor repairs, all the way up to major renovations.
That's crazy. I have a small portfolio, and I'm having a hard time managing that small portfolio. Imagine having 400 units. My head just blew up. So, because you have that, you invest in Kirkland Lake.
Yes.
I feel that I have to ask this question first. Why Kirkland Lake?
Well, if you look at investing, people need to have different goals, right? And that's the beautiful thing about investing, is everybody's going to have a different journey. So the way I look at it is you can have primary markets, which would be like Toronto, where you see really significant appreciation but very little cash flow. You can have secondary markets that I would say, maybe that would be, at least pre-pandemic anyways, that would have been, say for example, Hamilton or London or smaller markets like that, where you have sort of a balance between appreciation and cash flow. And then you have tertiary markets, which are the smaller ones. So this is where you go when you want to generate cash flow, but you don't see appreciation that's as significant as larger markets. So we started in Kirkland Lake because my husband wanted to leave his job and we wanted to generate cash flow. So that's how we ended up there.
So how's appreciation like? Because you started in 2005, and how's the appreciation like from 2005 to now?
Well, we first bought in Kirkland Lake in 2010, and the appreciation has been significant. Now, granted, the purchase price was not as high as it would have been to buy down here, and the appreciation has not been as significant. So, say for example, in Oakville, where we are, you might have seen appreciation rates of 15% over the last however many years. In Kirkland Lake, as a smaller market, we might have seen appreciation rates of 8%. And we usually, we usually lag a little bit behind. So, in pandemic, everything just kept growing and growing and growing. In Kirkland Lake, we didn't see that translate into the real estate market for probably 6 months, I would say, after was when we really started to see the market intensifying and heating up.
Well, that leads to my question perfectly. So, people often say that when they invest in, well, actually, backtrack a little bit. People often come to me and say, hey, Cherry, how do I retire with this particular real estate investing thing? Because there's a lot of advertisement out there saying that you find your financial freedom. FIRE, I think it's called financial, I don't remember now, but it's the whole movement that you can retire using real estate.
Right.
But I always tell people that is not an easy path, and you won't get there probably in the next 10 years. And that, I think, ties it back to why you invest in Kirkland Lake. And I know you mentioned that that the appreciation is only 8% as in comparison to, like, for example, in Oakville, 15%. But at the same time, you're getting cash flow, and you're doing negative cash flow here.
Yes.
If you invest here, right?
Yes.
Yeah.
Absolutely.
So what would you, would you say that the cash flow, like when you start investing, you had a really clear goal in terms of what you're trying to achieve?
So I would say we had a pretty clear goal. I would say that we hadn't done enough research to understand what the strategies we had chosen, what that would translate into on a day-to-day basis. So when we bought properties up north, we anticipated that we were going to have a property manager and the properties were going to be looked after and we were going to be hands-off passive investors. And that is not what ended up happening. So hence why we opened our property management company and hired staff and started managing for ourselves. And then as people saw that we had a company, then they started asking us to manage for them. So I think it's really important for new investors to really, when you're looking at strategies, the first thing you need to know are what your goals are. And then once you know what your goals are, you need to do your research in terms of, if I choose this investment strategy or if I choose this market, what is that going to look like for me? So things like BRRRRs that are really popular right now, a lot of people don't realize how hands-on you need to be during the renovation stage, and then they don't realize what the cash flow is going to look like afterwards, because typically, unless you're putting in a third unit on a duplex, your cash flow on a BRRRR might not be as significant as you want or need it to be when you have the goal of leaving your job. So it's important that you're considering all the right factors as you're planning your future, strategy and the next few deals that you're going to do in real estate.
That's amazing advice, because I was talking to Erwin and I was trying to convince him to buy set up duplex because I want the minimum amount of work for myself.
Yeah.
I want to buy a set up duplex that I could just rent it out. I don't care about the BRRRR part because that means more work.
Yes.
Yes, the higher the return, the more work it's involved, right?
Yes.
So that brings us to another question that I have. So since you've coached for so many years, what's the number one biggest mistake you've seen in beginner real estate investor?
Well, I would say there's probably two. So the first one I would say is that people believe that they need to take their capital and put all of it into acquiring properties, and they don't invest in themselves first. So they don't invest in, getting in front of the right people, surrounding themselves with the right team members, and educating themselves on what they should need and what they need to know before they start buying properties. So what you see is a lot of investors, as they're starting out, they make the same kinds of mistakes over and over again. And if they had invested in a bit of an education and gotten themselves some support, they probably wouldn't have made those same mistakes. The second thing I see that is an obstacle for investors is the fear of making mistakes, which translates into a lot of people not ever taking action, not pulling the trigger, not doing deals, and not moving forward. And I think the quality of the team that you surround yourself with is really what determines whether you allow that fear to sort of take over, or whether you say, no matter what happens, like, I've got a good team, I'm going to figure this out, I've got my exit strategies all lined up, I can do this.
That's amazing. Yes, that's the reason why you need to have Elizabeth Kelly as your coach, because I feel like it helps a lot. I personally have quite a few business mentors as I build up my accounting practice, and all of them had very degree of my contributed in various degrees to my current success. It's not even a huge business, it's just a small business, but it is growing and I'm really happy about it. And a lot of it has to do with all these coaches.
Yeah.
And essentially you don't want to repeat the mistakes that people already made, and you can avoid it by having someone showing you the way. Now, so now that you have so many, you've managed all these properties, have a portfolio, and you've coached so many people, is there a particular strategy that you prefer over one over another?
I'd have to say my favorite investment strategy, I love rent to owns and I love private lending. And those are my two sort of, in a perfect world, when I retire from having, multi-unit buildings and doing property management and everything else, that's where I'll settle down to, is doing some rent to owns and doing some private lending.
That's great. So tell us a little bit about private lending. I've never had anyone talking about private lending.
Okay.
before, and I'm actually in the middle of writing a blog post about private lending.
Okay.
And we had we had a lot of success. Clients share their success stories with us about private lending, and it can be done in RSP and TFSA. The only thing is that we also have a couple of failure in the last couple of years.
Okay.
Not a lot, but it's in comparison to the amount of success that we've heard. But just like everything else, there is good deals and there are bad deals. And I could already name the bad stuff that should have been considered before going into it.
Yeah.
So tell me what, like, I know you have a lot more experience than I do in terms of private lending. Tell me what other people should look for in a deal.
Well, we've been on both sides of it, so it depends which perspective you're speaking about it from. But in my experience, you need to approach a private lending deal just the way you would approach any other investment opportunity. So you need to look at the borrower and what security is being offered and what their reputation is and what their track record is. You need to look at the deal itself. What are the terms and conditions that the money is being lent under? You need to look at the property and the market, and you need to say, if this doesn't go the way I planned, what are the next steps? What is the process that I need to follow, whether it's power of sale or foreclosure, depending on the circumstances and the location, and am I comfortable taking back and owning this property? Typically, the biggest period of risk is when, let's say, for example, you lend funds that are going to be used for renovations, so the borrower has torn the property apart and then they don't complete the renovations. So it's actually worth less than when they bought it. So that's sort of the most risky period of time, and you really want to take a look at, what contingency plans are in place. Are you comfortable owning this property in the future? How likely do you believe it is that your borrower is going to follow through on the plan? Those are the types of questions that you need to ask yourself, for sure.
You've done it all.
Not everything. I mean, I haven't done, a lot of land development and that kind of stuff. I could see that coming in the future, but I really feel like everybody's journey in real estate is different, and I feel like it's important that we all sort of figure out what our journey looks like and make sure that the strategies we're choosing and the time that we're putting in is a match for the life that we want to create in the future. Okay,
I'm going to ask my final question. Second final question. But I'm going to ask about more of an from a more seasonal real estate investor's perspective. Now that I've got my 3-4 properties under my belt and I max out my credit, I max out my income, there's always this term called OPM. And there's all these terms. It actually stands for other people's money, OPM.
Gotcha.
So I see a lot of programs or even gurus out there promoting using OPM to finance the purchase. So tell us what your thoughts are about using other people's money to form joint ventures, or actually just borrowing, I guess is the other side of private lending, to purchase properties to grow your portfolio. Do you like it? What are the downsides?
Definitely, I think joint venture partnerships are super powerful. For a lot of us as investors, myself included, I wouldn't have been able to grow to the size that I have without my joint venture partners. So I'm always very grateful for them. And I think it's a part of pretty much every investor's portfolio. The challenge comes with now you have somebody else that you need to run decisions by. There's somebody else that you need to take into account their opinions and those kinds of things. So it adds another layer of complexity. Like you said, in this scenario, I typically, when I'm working with my clients, we figure out ways to maximize all their financing opportunities first, and then when they are completely done and there's nothing else they can do, then we move on to joint venture partnerships. I also think it's beneficial that you have a couple of deals, you have some experience, you have some expertise before you start looking for partners, because how can you go to someone and say, I've never done this before, I've never tried this out, but I want to do this, do you want to do it with me? I prefer to make my mistakes with my own money first.
Absolutely.
Perfect my systems and processes, and then from there be able to move on and be able to show other people that I have a history of success and I can be trusted with their money. Because it is trust. It's people taking their hard-earned funds, their retirement funds, and entrusting them to us to generate a return for them.
Okay, I just thought of another unscripted question. What's the worst tenant stories that you have worst in the history of owning so many units?
Okay, so the most expensive story I have is from a rent-to-own. We bought a beautiful century farmhouse on 3/4 of an acre of property. My tenant buyer moved in. Everything was great. Unfortunately, during the time that she was with us, she split up with her partner, had a mental breakdown, stopped paying the bills. So by the time we got out there, this is in southwestern Ontario, by the time we got out there and we walked through the property, we realized that that she had basically turned the property over to the feral cats.
Oh.
So there had to have been 20 feral cats running around, and then she also had, in each of the rooms, she had set up like a different type of animal. So she had a bird room where when you went in, there was newspaper and bird waste all over the floor to the point where you couldn't open the door. It was about this thick. And then she had 5 or 6 bird cages all around with different birds. And then you went to the next room, and then she had all the rodents. And so there was all kinds of tanks and all kinds of stuff. So by the time we were done, we figured she had about 75 animals total on the property. And the damages were about $70,000.
So, okay, I want happy ending.
Oh,
Is
there's
there
a happy ending.
What's the happy ending? Tell me.
So the happy ending is that she was charged criminally for what happened.
Awesome.
And because of that, we always make sure we have great insurance policies. So we will pay extra to have insurance that costs extra. So in this particular case, this was classified as tenant damage, and our insurance company paid everything.
Oh
We
my
got
God, that's
all the
awesome.
repairs covered. We turned around and sold the house for more than she was originally slated to buy it for.
That's excellent.
It ended up working out,
Yeah.
but I think that really shows you the importance of having the right people around you. So our insurance broker, it also shows you the importance of choosing the right property in the right market. So we picked an area where the appreciation was good, where there was the opportunity for upside in the property. So there's a lot of fundamentals that deal particularly really hit. And our investors ended up, despite putting in additional time and energy, our investors were really happy with the return at the end. So.
That's amazing. At least there's a happy ending. There's always a way to fix a real estate deal.
Yeah.
Yeah. So for anyone who wants to get more coaching, get more information about you and about your coaching program, how do they contact you?
I'm really easy to find, just Elizabeth Kelly Consulting. And I'm happy to work with new and seasoned investors. So if you've got a real estate challenge and you're looking for some support, more than happy to have a chat with you and see what I can do to help.
Yeah, thank you so much for coming on.
Thank
if you
you.
like our video, make sure that you give us a like and subscribe to our YouTube channel. And I'll post Elizabeth's contact information in our show notes as well.
Perfect. Thank
Yeah.
you so much, Cherry. This was a pleasure.
Thank you so much.